righty, beautiful people. Welcome back to the show. He's a first-time guest, and I'm super blessed to have him on. His name's Michael Blythe. How are you, Michael? You well?
I'm very well, thanks, and I hope you are as well.
Yeah, thank you, sir. I wondered, could you just give us an intro, I guess, of who you are and what you do?
Sure. Well, I'm an economist, and I guess compared to the sorts of different careers, if you like, or different companies people work for, my career has really been quite boring. Now, after I finished my economics degree, I was lucky to get a job at the Reserve Bank of Australia. And as an economist, fantastic place because you're working with some of the smartest people in the country. You learn far more about economics and how the economy works there than you do, sitting in a university lecture. So fantastic grounding from that perspective. It was so good. I was there for 13 years, and then an offer came up from the Commonwealth Bank. They were looking for an economist, and I joined and became their chief economist, which is where I was for about 24 years. So long time talking about GDP and the CPI and what interest rates are going to do next, that kind of thing. But it has been a very interesting time when you think of all the things that have happened over the last 30 plus years with the economy. Since then, I've just been doing a few kind of minor consulting roles just to keep my hand in, keep the mind active, and of course, a bit of cash flow is always a good thing to have as well.
Yeah, 100%. I've only been in finance for 2 or 3 years at this point, and I notice during times where the RBA is raising the official cash rate each month, like sort of the cycle we've sort of been in since I think May of 2022, the type of negative commentary you tend to see in the media is quite prominent, and it seems to be all that a lot of the financial papers might be covering. Has that always sort of been the case? Like, speaking from your experience, you were working there for a while back in the day as well. Was that always something that they sort of do, or is that maybe a new phenomenon?
No, it's a big problem of perception for people like the Reserve Bank. I mean, in the end, they are doing what they think is best for the economy, and the best contribution they can make to the economy is keeping inflation low and stable. That's the way you maximise employment, and that's what gets missing in the commentary. I think it's very easy to double the unemployment rate in Australia. You have a recession, it'll double within a 6-month period, basically. So you want to avoid that, and as I say, the best way to avoid that is to kind of keep those fluctuations in the economy pretty tightly controlled. And the Reserve Bank, in the end, they've really only got one policy instrument, and that is interest rates.
Yeah.
And of course, people with a mortgage do feel the pain there. But when you look at the numbers, it's something like about a third of the population have a mortgage. So they're the ones that certainly feel the heat when rates go up. But the other 2/3 don't. So they're either not touched, or in fact they're savers, and they actually benefit when interest rates rise. So you've only got to think of the last 12, 18 months, where term deposit rates have gone from less than 0.5% up to 4 to 5% now, to see how there is another side to this particular story. And I can tell you, the Reserve Bank gets as many letters about interest rates being too low from those savers as they do about the borrowers who are obviously feeling the heat from higher rates.
But yeah, it seems like during the really low interest rate period during the pandemic, there was definitely articles in the ABC and such of, people in their older years or retirement years who were not super happy that their savings accounts weren't making much of an interest. But at the same time, you were seeing this huge property boom where a lot of people's property prices were just going up and up because among other things, people were able to borrow more money than maybe they could have during a higher rate cycle, right?
Yeah, I mean that's right. It's always easy to pick one bit of the overall story and concentrate on that, or newspapers and so on. They love to play off the winners versus the losers type angle, because that's what makes the exciting headlines and so on. But you've got to look at the whole picture. And I mean, even now, we'll all agree that higher rates are bad for borrowers, but you look at the kind of profit announcements the bank's been putting out over the last 6 months or so. I mean, what stands out to me is how many people are not really affected because they're so far ahead in their loan repayments. A very high proportion of people are more than 2 years ahead in their loan repayments. So this rate rise cycle shouldn't really hurt them too much at all. They've done it in a very simple way. When interest rates were coming down a few years ago, a lot of people just kept their home loan payments constant. And of course, they just accelerated the rate that they were paying off those loans. So, you can find ways to deal with these issues. And even the more recent borrowers who haven't had time to do that, what are we seeing right now? Well, refinancing of home loans is running at a record high. And a lot of that is being done at rates that are better than the kind of headline rates you see again advertised in the newspapers. So people have found a way to kind of offset some of that pain. And the other story that comes to mind here, of course, is go back 6 months ago, and it was all about this mortgage cliff that we were about to go over, and what a disaster that was going to be for the banks, for individuals, for the economy, and so on. Well, again, on the bank statements, their profit announcements recently, I mean, we're more than halfway down that mortgage cliff, and so far so good. Fingers crossed, maybe, but it does look like we're even dealing with that kind of extreme event.
Yeah. I'm still at a point where I'm probably a little prone to being sucked into some of the headlines about things like the mortgage cliff or people's cost of living's becoming really untenable. But then, like where I live in Dubbo, there's a couple of shopping centres around me. And if I go to the shopping centre from a Friday all the way to a Sunday arvo, select shops might look like they're struggling, but for the most part, people are still lining up to pay $12 for a Boost juice. Do you know what I mean? Like people are still spending a lot of money at the Donut King or the Baker's Delight or the grocery store. So I try to, it's very hard for me, and I'm sure it's hard for a lot of people to sort of pass what you're reading is going on with what you're actually seeing to see where that like middle ground is. But yeah, it's hard to judge.
Yeah, I mean, we can't deny it. There is no doubt there is a subset of the population that is doing it really tough at the moment. They're not the dominant part, and in the end, policymakers, the RBA, they're kind of dealing with the average household. That's the only kind of metric that they can look at. They can't set policy for one group over the other. It's got to be the average. It's got to be what does it mean for the long term, not just for the next month as well.
Yeah, it might be a bit inside of baseball, but I guess some of the talk that's been going on recently with ways of addressing inflation is almost that it has to go hand in hand with how government roll out policy, whether it's raising taxes, reducing taxes on certain things. And I just wondered, like, from your point of view, what would you think you'd want to see from the government that would, I guess, have a greater impact on reducing inflation? If the RBA only really have one thing they can do to sort of address inflation the way they're doing it, what part would the government have to play in figuring out ways that they could help bring down inflation?
Yeah, well, that's always been the difficult question, really. Fiscal policy, government policy, it should be able to do something, but you don't get many chances to change policy. We have the big budget in May every year, and for sure you could probably do little bits and pieces in between times, but interest rates is easy. Reserve Bank meets once every month. You can change them or not, as the case may be. So I suppose what you've really got to look at is beyond the kind of consumer side. So we know one of the other big inflation pressures in the economy at the moment is coming through construction activity, particularly infrastructure spending. We're trying to do a lot of very worthwhile projects, but we're trying to do them all at once. And the impact from there on construction material prices, construction wages, and so on is something that's actually feeding into the broader inflation story. I'm a little bit torn on this one because I think infrastructure is a great idea, and the more we do, the better. But it is something clearly feeding into the construction side, or to the inflation side of the story at the moment. Beyond that, to just kind of change the question slightly, we talk about the cost of living crisis and the squeeze on household incomes in particular. And that's absolutely true, of course, because wages are growing at a slower rate than inflation. So real wages are falling. Interest payments have gone up. They're taking more of that income. But what people are missing, and to be honest, I was surprised myself when I noticed this, that the other big drag on household disposable income at the moment is income tax. It's growing very quickly. Now, that's partly because there are more people with jobs and wages have gone up a little bit. but income tax per person is growing at the fastest rate in 10 years. So part of that squeeze on households at the moment is coming from the government. So they could, presumably do something on the tax front as well that may not help so much on inflation, but it would take some of that pressure off the cost of living story that's really kind of dominant for households right now.
Mm.
So, like interest rates, you've got to kind of look at both sides of the story here. And the government can provide some of the solution, but it also appears they're part of the problem
Yeah,
at
okay.
the moment.
Yeah, just to expand on that for people listening, is the way that income taxes have been rising, is that because more people are going up into that bracket where like more people are getting more income, so they move into that higher bracket, or have the government changed the tax brackets? Like, how does that work?
Yeah, look, it's a little bit of both, I suppose.
Okay.
I mean, wages are growing, and so if you're close to the top of one income tax band, it doesn't take too much to kind of push you into the next one. But I think the biggest driver at the moment is employment. Well, the unemployment was supposed to be going up, but it isn't, and that's because employment's kept growing. So we've got more taxpayers. So we've got a lot more
Okay.
taxpayers. They're earning a little bit more, and government revenue is one of the beneficiaries of that. We do have some tax cuts coming up in the middle of 2024. The stage 3 tax cuts, as they're called, and there's a lot of debate about those at the moment. Should they be cancelled? Should the money be used for something else, and the like? But if taxes are part of the problem, then I think the people who want to get rid of these tax cuts or use the money somewhere else need to kind of explain how they're going to help households. So once again, when you start digging behind the surface, there's a lot of different kind of pushes and pulls here.
Yeah, okay. Switching to, I guess, the career side of it, speaking on yourself, like we talked about it before we did this podcast, like looking at your LinkedIn page is pretty awesome. Like you've done some pretty cool stuff across, you've sort of had your fingers in a bunch of different pies. And I just wondered, like looking back at your career, what moments do you look back on the most favorably? And I guess the moments that feel the most pivotal or the most proud for you looking back on your career so far, that you sort of, I don't know, bring a smile to your face considering the different range of experiences you've had in the industry?
Well, I suppose there's a couple of things there. One to put in kind of context. I came to realise after a while that a lot of my job was really selling insurance, if I could put it that way. So, as chief economist, I would go and speak to a whole range of the Commonwealth Bank's clients. So, the top end of town, the superannuation funds, and so on. Now, these are smart people. They're not waiting for someone like me to turn up and tell them what to think. But what they want to know is, what am I thinking about? That might be a risk or issue that they haven't thought about, or what's my interpretation of this particular issue that might be playing out at the moment. So it was kind of getting plugged in at that level, and hopefully providing some kind of positive input was one of the things I used to enjoy. And we go further across the spectrum, and a lot of corporates speak to them, and of course they don't maintain their own teams of economists and forecasters, so they really do want a lot of input into where interest rates going, where's the currency going, because big business decisions hang off that. And you're giving your best view at the time. But again, it was kind of insurance for them that they've got somebody else to blame if it all goes wrong, I suppose. But in terms of one of the highlights as such, dates back a while now, but back in 2000, the global financial crisis was really going, and there was a bit of a competition amongst economists to come up with the most negative view on how it was all going to play out. Plenty of people forecasting 10% drops in GDP and all that kind of thing. And I kind of sat back for a few weeks and I went right through it all, and I just thought, I just can't see this happening. Sure, it's a big financial shock, and they're always a bit unpredictable. But I came out at the time and said there's going to be no recession, and pretty much everybody laughed at me, including my boss at the time. But as things turn out, much to my relief, that was the call. Sure, we had some pretty weak economic growth there for a while, but it was nothing like a recession. The unemployment rate didn't triple or whatever as people were predicting at the time, and so that's the one that brings a smile to my face, I suppose, and it does highlight every big negative shock that we get. The immediate reaction is to think up the worst possible scenario, and most of the time it doesn't happen. So it's one of the big lessons, I think, of the last 30, 40 years I've been in the industry.
I'm definitely not the first person to think this, but do you think when you look through, I guess, the day-to-day articles that are telling you how the world's gonna end and the financial crisis is gonna hit or the mortgage cliff or whatever, do you think the editors of these newspapers are saying, hey, write this, write that? Or do you think they just have journalists on staff that they know have these sorts of opinions to begin with? Do you know what I mean? Like, is it the chicken or the egg?
I think it's like a self-reinforcing circle in a
Uh,
way, and the everybody in the industry knows that what sells newspapers is a negative headline. That's what
yeah,
people want to read about because they're immediately worried about what it might mean for them and so on. So I think there is a bit of an inbuilt tendency to kind of write things up in a negative way. Now it's not true of all journalists, and it's not true of all editors, but there have been the rare occasion where somebody's basically written a story and they want a quote to fit in with what they've written. It's basically on the lines of, can you give me a quote that fits in with this particular view? And if you can't,
mm,
I'll just go and find somebody who can. So that doesn't happen very often, I should say. Most
yeah,
journalists, they're trying to do the right thing
yeah,
and so on. But without a doubt, there is a bias there, I think, to favour the negatives over the
yeah.
positives.
Yeah, for sure. I guess looking back on your life and the lessons you've learned, and this question can sort of be what you want to make of it, whether you talk on career stuff or investing stuff or just life in general. If you could go back to a 25-year-old version of yourself and assuming that he listens to what you have to say, what advice do you think you would give that version of you?
Well, when I look back over the years, the one big lesson, if you're thinking about it from the investment side, really has been buy and hold.
Mm,
Trying to trade in and out. Yeah, maybe you get the timing right and you make some money. Property, I guess, is a classic example here, where I bought my first place in 1988, and I've still got it. And yes, it is worth a lot more than when I bought it then, and I haven't done really anything. And to be honest, it's not so much an investment strategy; it's kind of inertia. But looking back, that's the results. And I'll give you another classic example of a kind of a mistake here. I've been working for the Commonwealth Bank for probably about 12 months. Because at that point, the government decided they were going to sell the other half of the CBA that they still owned. And so CBA put out a deal for the staff where you could buy 500 shares at, I think it was like a 10% discount.
mm,
I thought, I'm working for this organisation. I probably should have some skin in the game and buy some of these shares. Looked at the price, CBA share price at the time was about $16. And I thought, well, that's a bit rich. So I only bought 400 to 500 I could have bought. And of course, buy and hold again, although $16 shares are now worth, I think, a bit over $100.
yeah,
As I say, it's not so much timing into the market, it's time in the market that
yeah,
kicks up. The one other lesson that I wish I had paid more attention to was superannuation. Typical 25-year-old like me doesn't really think about that much at all because it's so
yeah,
far in the future. But you get to the point where it suddenly becomes very important. And all those sorts of things you could have been doing over the previous couple of decades you haven't done, and it does impact on your retirement savings and what you can do in that retirement. So focusing on some of those things earlier, I think, is a pretty important lesson, and not a bad investment strategy as well.
yeah. Okay. And I wanted to try and spend as much time as we could before we got out of here on downsizer, because that's sort of how I heard about you in the beginning. I think it was a Fin Review article I read of you, that you were in and talking about downsizer. So I just wondered, like, give us, I guess, the Cliff's Notes of it. Like, what's the work you're doing there? And obviously, there's a big thing going on with an undersupply of housing for both people trying to buy to live in or just people trying to get into the rental market. And for the first time in my lifetime that I've been reading about it, it feels like it's happening everywhere. It's not unique to Sydney or Melbourne, like maybe when I was growing up, where that's where it just felt like renting in Sydney was crazy. You'd have to be in a share house with 8 people to even get by. But now it feels like it's sort of happening everywhere. And obviously, Downsizer has an aim of trying to contribute to fixing that problem. So I just wondered what's going on at Downsizer.
Sure. Look, a few months ago, the government put out this thing called the Intergenerational Report, and it basically looked at all the risks and problems the economy was going to face over the next 30 to 40 years. 298 pages. I could summarise it down for you to one sentence, and that is that we're all getting older. It shouldn't be a surprise, but it is. It's happening right now. It's not something that's over the horizon. But one of the outcomes of that is that the houses people live in are getting older as well. Now, there's two parts to that story because, again, people have been in these houses for a long time. It's been a great way to generate wealth. But equally, those big houses are no longer really fit for purpose. They come with rising maintenance costs. They've got big gardens normally that become harder and harder to look after, and the number of people in those dwellings declines. Just through that aging process, and plays into this housing crisis story in particular. Based on the last census, you can work out there are about 13 million spare bedrooms in Australia. So it's not so much we've got a housing shortage; it's more that we've got an excess of bedrooms. They're just in the wrong place. Well, how can you resolve that? Well, you can encourage these older households who are living in the wrong type of accommodation to move to something more appropriate for them, and then you come across this gap in the market. So a lot of these older households, they are asset rich because that house is worth a fortune, but they're cash poor. So they may want to move, but it's hard to find that kind of 10% deposit that will secure you into that new development that's going to take 2 years to build. So the kind of innovative financing idea that Downsizer came up with using a deposit bond. So essentially, you would pay Downsizer a fee, which is much less than the 10 deposit. And then the deposit bond then covers the 10% deposit to the developer. So you don't need to find the money until you actually sell your dwelling to move into the new one. So it gets you over that gap without having to sell your house now to try and pay that 10%, which means you're then paying rent for the next couple of years. And even if you've got enough in savings, if you take that 10% out of your savings, well, you're losing a lot of the interest income that you're relied to live on during that 2-year period as well. So it's a pretty cheap and effective way, I think, for potential downsizers to fill in that gap. And of course, there are other benefits here that are not fully appreciated, I think, and that is when you sell your big house and buy the typically smaller and cheaper one, you're actually freeing up some equity, which you can then use to generate income, which again, obviously very useful. And while I tend to be critical of the government on these sorts of things, they have done one very useful thing, and that is they've created this downsizer contribution scheme into superannuation. And we tend to call it superannuation's greatest secret because not many people seem to know about it. But effectively, when you downsize, you can put $300,000 as an individual or $600,000 as a couple into superannuation in a way that doesn't affect any of your other kind of superannuation calculations. So it helps preserve wealth and, of course, it generates income. And so if you took full advantage of that $600,000 into super, it would generate a bit over $40,000 worth of extra income for you every year. I say it's a secret because this scheme's been around since 2018, and over that time, less than 60,000 people have actually taken it up. So there's some very powerful incentives there, but just nobody seems to know about them.
I feel like if you wanted to get into an industry that wasn't going anywhere, you'd get into funeral homes or you'd get into superannuation companies, I feel like.
Yeah.
I don't know if this is something that your work as an economist could speak to, but I think about it where a few of my friends recently had kids and had to look at moving out of smaller townhouses or units in inner city Melbourne, where I used to live, to then opt to move out into the outer suburbs where they could afford to get something bigger because there was nothing close to the city that would fit their needs anymore. But then there's flow-on effects from that because now you've got much longer commute times, much more money spent on fuel and maintenance of your vehicle. And I just wondered, is there something to that is it almost, because you have to move further away from where you work if you work in the city, that can almost handicap your ability to move upwards economically later on down the line because your costs have all gone up at a time when you're also sort of doing that family formation stage. I hear the words upward mobility thrown around. I don't know if that's actually what it means, but I just wondered, is that something you know much about? Because I'm still trying to get my head around it.
Yeah, I mean, there's no doubt at all that it's income determines how kind of mobile you are, and it works
Okay.
both ways, as you say, depending on where you live and the time, and cost of getting to work and getting back again is a big part of people's budgets. So we look at car ownership. It's highest kind of west of the main cities, because that's where the public transport's the worst, and where everybody needs a car to get to work or
Yeah.
shopping or whatever it may be. And that's after the house, your car is probably your biggest cost when you think about it. Just not buying it, but running it and so on. So again, there's a couple of things here. Downsizing helps, I guess, in the sense that you're freeing up those bigger homes that that group you're talking about want. But part of the reason people don't downsize is because they want to stay where they are, and that's fair enough. But they can't find the type of dwelling they're looking for where they live. So one of the things you've got to get right here is all those kind of government and zoning regulations that determine what you can build. So you've got to build the right stuff that allows downsizers to free up these big houses that other people want.
Mm.
It also comes back to that comment I made about infrastructure earlier on. Get the infrastructure right, and the distance doesn't matter so much. You build a high-speed rail line. You allow people to access the cheaper land, the cheaper properties that are further out from the centre of the city, but you also allow them to get into work in a reasonable time frame as well. And it's one of the reasons I think even though it's contributing to inflation, we need to kind of push on with this infrastructure. Because at least a lot of it's going into that kind of transport infrastructure that we probably should have built 50 years ago.
Yeah.
To be honest, but at least we're moving in the right direction on that front.
Yeah.
So there are solutions to these problems that mean distance shouldn't be as big an issue as it is right now. But it's just going to take time, unfortunately.
Yeah. I'm happy to sit here and make critique of government. Never want to be in government.
Absolutely. Opposition is a nice place to be.
Yeah, it's way more fun. I just wondered, like, before we get out of here, do you want to just let people know, like, if there's any way they can sort of follow any of your work, if you put anything out, any social media or anything like that, where people can, stay up to date with what you're up to? Otherwise, we'll make a move and get out of here.
Sure. Look, I'm a bit of a novice when it comes to social media, I'm afraid, but most of what I do publish appears on LinkedIn.
Okay.
So you can certainly find it there. If you're interested in the downsizing story, well, everything that I publish for them appears on their website, downsizer.com. So you can get all the information there, particularly the superannuation story, which I think, as I say, it's a bit of a secret, but there's a lot of benefits for those who are thinking about downsizing in that particular secret, if they want to look further at that.
Yeah, plus that's a great scheme, because it's something I hear a lot from financial planners is how they might meet up with a couple in their 50s approaching retirement who have just realized their super balance isn't worth what they probably hoped it would be. And they're sort of on the back end where they're sort of looking for what solutions can help them. And that's a perfect solution, being able to make this bulk payment into your superannuation that is going to get a little bit of compounding interest before you retire and seize it, right? It's a great idea. Yeah. It's a shame they haven't been able to spread the word about that more than what they have.
Yes, I agree. It's certainly worth a look. And if you're asset rich and cash poor, downsizing is one of the ways you can solve that problem for yourself, and it helps the broadest economy story or housing story by freeing up that housing stock that's kind of too big for the people who are living there currently. So it's got some nice flow-on effects for the bigger picture story as well.
Yeah, exactly. Well, I'll keep you on once I stop this, Michael, just to ask one or two more questions. But thank you very much. I really appreciate you taking the time out, letting me pick your brain for this. And thanks again. We'll have to do it again.
Yep, that was great. Thank you.
Thank you, sir.